After helping 4 clients with this strategy, I'm very excited to share with you about how I'm going to change your understanding of mortgage finance and help you save a ton of money. Now, I do want to stress that this is the type of individual help that you get when you work with an independent mortgage advisor, someone on the broker channel versus a retail mortgage advisor that works at a bank. And so whether you're a realtor that helps your clients, or if you're a prospective home buyer that's been looking around, make sure you're working with someone who's going to go over your independent scenario with you, learn about your needs, wants, and goals, and figure out a strategy that's personalized to you. You're simply not doing yourself a favor by going to a retail mortgage company.
Okay, so in this video, I'm going to teach you 3 things. The first thing is that whether or not it would make sense for you to consolidate your liabilities into one and save on a monthly basis. The second thing that I'm going to teach you is how to use some of that savings every single month to save more money on your new mortgage. Now listen up, here's the big one. The third thing I'm going to teach you is how to use some of your mortgage interest that you pay every single month to pay down the principal on your home and save a lot of money on your mortgage and reduce the time of your mortgage as well without coming out of pocket per se. Okay, so I'm going to give you a scenario where you have a mortgage payment of $1,923 a month, taxes and insurance are $350 a month, you had a car payment of $538 a month, you have a personal loan for $245 a month, and your credit card payments come out to about $194 a month. That's a total of $3,250 a month. Now, for those of you who have a mortgage that is significantly higher, do the same example, add another $1,000 to the mortgage payment. All right, the key here is we are going to eliminate all of your revolving debt. Now, home equity is an all-time high in the country, and we're going to utilize that to save money every single month. So in this scenario, let's say you pull out $55,000 to pay off all your liabilities. That brings your new payment to $2,200 a month. And then that gives you a monthly savings of $1,000 per month every single month. Well, I'm not going to ask you to use $1,000 and apply it towards your house. We're going to go through a scenario here for you. Okay, so let's say your new mortgage is $2,200 a month and you have $1,000 savings every month. I'd like you to take half of that. So we're going to apply just $500 a month and pay that towards the principal as an extra principal payment every single month on your mortgage. Now, if your concern is starting over in a 30-year mortgage, you don't have to. We can do a customized mortgage for the exact amount of years that you want to do, so you don't have to start over. But I'm going to show you a trick here that negates a lot of time. But for the sake of the example, let's say that you start over brand new 30 years. Okay, by applying $500 a month towards the principal, you're going to reduce your mortgage by 10 years and 6 months. So you will actually have that paid off in under 20 years, not a 30-year mortgage. But wait, there's more. By paying down the principal every single month by $500, you are going to save over $193,000 in interest that you would have paid otherwise by making normal payments. Now wait again, there's even more to this. And here's the beauty. Depending on your family scenario, the IRS allows you to deduct the mortgage interest that you pay on your primary residence. Now, if you don't know about an amortization table, I'm going to show you how much money you're paying in year 1 of your mortgage, only on interest. So once you figure out if you can deduct the mortgage interest on your primary residence, I want you to take that money you get back on your tax returns, and it all depends on your tax responsibility or your tax liability, but take the money you get back on your tax return and go and apply that towards the principal of your home as well. You are not only going to reduce your home by 10 years, you're going to reduce it by a lot more. All that being said, it's important who you choose as your mortgage advisor, whether you're a realtor sending clients to mortgage originators, or whether you are a home buyer yourself. Although you might choose a 30-year mortgage, you don't have to pay on it for 30 years, and you can save a lot of money.